Welcome back to Reporter's Diary. Moving to all the earning action of the day. ICICI Bank has reported third quarter numbers. Asset quality has taken a hit, with gross NPAs jumping over 17% sequentially to a little over 37,700 crore rupees. Now, net profit also saw a sharp fall, but that dip wasn't as severe as expected by the street. Ritu is here to take us through the highlights of that earnings report. Ritu, seems like a disappointing set of numbers.
Well, absolutely. Very, very disappointing set of numbers from ICICI Bank, primarily because asset quality pressures continue to weigh heavily on the bank. Profits declined by over 19%, although it was above what the street was expecting. It was on account of lower net interest income and lower operating profit. Despite the fact that provisions have fallen over 61% sequentially, about 4.6% over last year, profits were still lower by about 19%. Net interest income also was down by about 1.6%. Margins contracted to 3.12%. Advances also very slow. The total advances growth was just 5%, and the domestic advances growth was 12% over last year, although the sequential growth was significantly lower. It was obviously led by retail, which grew by 18% over last year. So the focus, of course, is on asset quality. The fresh slippages, or the fresh addition to bad loans in this quarter, was 7,037 crores, although lower than the previous quarter of over 8,000 crores. It is still a large amount in absolute terms. Of this, about 6,600 crore of the total slippages came from the corporate and the SME book. And of the 6,600 crore, bulk or 75% of the slippages actually were from the drill down or the watch list of the bank, from the restructured book and the non-funded exposures. So the watch list, or the accounts that the bank is cautious on, still stands at roughly about 27,536 odd crores, down by roughly 5,000 crores from the previous quarter. Gross NPAs have jumped to 7.91% and net NPAs to 4.35%. So overall, a fairly disappointing set of numbers, although the only positive is that the pace of addition of bad loans has come off in this quarter.
About 75% of the gross additions to NPA for the wholesale and SME business in the third quarter were on account of slippages relating to companies internally rated below investment grade, that is the drill down list that we have disclosed, and the restructured portfolio, and the devolvement of non-fund facilities to accounts which are already classified as NPA in the prior periods.
And